Good morning. Thank you very much for having me. It's a wonderful honor to be here in Seoul. I've never been in Seoul or in Korea and was very excited to come. So I appreciate the opportunity to speak with you a little bit about what I see happening in the United States right now with economic policy generally, even spreading a little bit toward our global policy. I think it is very important to emphasize, as I always do, I do not speak for the Trump administration. I am not a member of the Trump administration. In fact, I have many criticisms of the Trump administration, some of which I will share as we are going along. But certainly my organization works closely with a lot of people in the administration, a lot of people in Congress, and have been involved for really the past 5 years in trying to make sense of what has gone wrong in the US economy, what has led to President Trump's political success, what has led to so many of the problems that we are facing as a nation. And so what I want to share with you is sort of where that thinking is coming from, how it is playing out in the policies that you are thinking, how that you are seeing, how maybe in some cases it conflicts with some of the policies you are seeing, and then also where I think going forward you are likely to see continued very significant changes in US policy. So I think the best way to understand what is going on in the US, particularly in economic terms, is that something has happened to capitalism. There is certainly, you will see surveys, this many young Americans now are socialist. We have always had surveys like that. The US is not becoming socialist. The US is deeply committed to free markets and capitalism, but there is very deep frustration in a way I think there has probably not been since the Great Depression with how capitalism is working or how it is not working. And so I think what you are seeing is a real rethinking on 3 different dimensions that I will talk about. There's a rethinking of the economic measures. What is even the data we should care about? There's a rethinking of the theory based on that. How is this supposed to be working? And then there's a rethinking of the policy. If this is supposed to be working differently than it is, how have we come to this place and how might we get out of it? So let me start with the measures, because by some measures the United States is certainly the world's strongest economy, is doing better than it ever has before. Household income is at an all-time high. Growth is certainly stronger than in much of the developed world. And the unemployment rate is low. So by a lot of the standard measures you would just look at every month, things look very good. The problem is that those things have not kept up with the actual experience of the typical worker. This is a chart adjusted for inflation of 4 very long-run trends in the United States. You see corporate profit per capita. I think it's very important to look per capita because if you just have a growing population, everything will become bigger and more valuable. But the profitability of our corporations has surged since the 1960s. Right along with it, GDP per capita. Right along with it, labor productivity. It's actually shocking over a 60-plus year period that you see almost exact comparable increases on all 3 of those figures. And then the dark red line at the bottom is the average wage earned by the typical American worker. The adjusted for inflation, the wage of the typical American worker was no different in 2022 than in 1972. If you look at a group like young men, men aged 25 to 29, they were even taking into account benefits, everything you can, they were earning less in 2020 than in 1970. And so as much as the top line figures have looked terrific, those have not actually translated into prosperity for the typical worker. And importantly, the way that we have made up for that is by having more people do more work. This is an analysis that we do at my organization, American Compass, that we call the Cost of Thriving Index. Because one thing you find in a lot of the economic data is it's fairly straightforward to just look at how much stuff do people have, how good is the stuff, and say, well, they have more than they've ever had before. Surely they are happy. And so what we did was we tried to look at things very differently. We threw out inflation. So don't try to correct year over year for what is happening to the value of money. Look at everything in nominal terms. and then just compare the income of the average male worker to the cost of the key things that you would think of as part of middle-class security. And so the red line here is the annual income of the median American male worker. And then those blue chunks are the major costs of middle-class security. Food for a family of 4, housing for a typical 3-bedroom house in a typical market, paying for a healthcare premium for insurance, operating a car, and paying for tuition at a public university. And what you see is back in the 1980s, at the beginning of the chart, actually, typical man, no college education, working full-time, earned more than enough to afford all of that for a family. In fact, it took about 40 weeks of work to earn it. There was money left over. Somewhere around the year 2000, that line crosses into the blue. And by the time you get to 2020, you would actually need about 62 weeks of work to afford the basic package of middle-class security. Now, people have obviously found ways to account for this. You're more likely to have a second parent working. We obviously have a lot of redistribution and subsidies so that government picks up the cost of these things. But the basic deal that was at the core of the American middle class prosperity that Americans think of as the economy working has broken. The choice you had, do you want to have a second parent working or would you rather have a second parent staying home, is mostly gone. You need to have 2 parents working. And so the idea that pretty much anybody, typical education, wherever they might live, is likely to be able to build a decent life, raise a family, achieve these basic things, has simply gone away. And what we've done instead is redistribute. And this is what we said we would do. We said we were going to grow the economic pie. That was the very popular term in the United States. The economy is a pie. We're going to grow the pie. We might fight a little bit about how much to divide up the pie, to redistribute, but as long as the pie grows and we cut it the right way, everybody can have more pie. And who doesn't like pie? The problem is that when you do that, you end up with a map that looks like this. This is a map of every county in the United States. This is excellent research from another group that we do work with called the Economic Innovation Group. And what they've done is shade every county by how much of the income in that county is coming from government transfers. So what you see is that in 1970, essentially nowhere was there significant dependence on government transfers. A few pockets of concentrated poverty, but for the most part, across the economy, incomes were being driven by earned income. If you fast forward, this is what the map looks like now. High levels of dependence on transfers have spread nationwide. Almost nobody is still at the very low level of dependence. And so again, you can do this. You can ensure that by doing this, everybody has more health care, everybody has better air conditioning, bigger cars. But what you've done is create a society where people don't actually feel like they can do it on their own. And certainly in the United States, that matters a great deal. So I think that's the microeconomic picture. That's how it has felt from the perspective of a family, from the perspective of a community. Let's flip around and look at the macro picture. What has actually been happening in our capitalist system? Well, one thing that's been happening is this. This is what I call the corporate erosion of capitalism. It's research that American Compass did a few years ago, and what we did was we just took every publicly traded company with financial data going back to the 1970s and looked at what they do with their cash flows. We defined a typical healthy capitalist company is generating profit. It's returning some of that profit to shareholders. It's also recycling some of that profit into capital investment to maintain and expand the capital base. We would call that a sustainer. And if you look back in the 1970s at that blue line, virtually all the market capitalization of the US was in sustainers. That is how capitalism is supposed to work. You could also imagine a company that was disgorging cash back to shareholders through buybacks, through dividends, so quickly that it wasn't even reinvesting enough to maintain its capital base. Depreciation was higher than capital expenditure. Now, that's not because the company was struggling. The company had enough profit to maintain its capital base. It was simply choosing not to. And we called that an eroder. And what you see is that that was virtually non-existent in the 1970s and 1980s. And by the early 2000s, it had actually surpassed the sustainers. At this point, the US economy actually, I would say it is safe to say a majority of market capitalization in our major firms is tied up in companies that is disgorging cash back to financial markets so quickly that it is not even maintaining its own capital base. Now, the argument you will hear from supporters of this financial model is that that's a good thing. If they don't have a good use for their capital, that's fine. They should return it to financial markets, and the financial markets will deploy it more productively. And if that were happening, what you would expect to see is a large jump in this third category, what we called growers. Growers were companies that actually needed access to capital. They needed to tap capital markets to raise money, to make investments, because they did not have sufficient cash flow of their own. There is no increase in the grower line. What is happening with the return of capital out of the operating economy back into financial markets is not reinvestment into new productive capacity, new activities. It is simply a return of that partly into just speculation and asset bubbles, and partly into financing our government debt. And as a result, you are seeing a very substantial erosion in the actual productive capacity of the American economy. I think one of the best ways to see that is just to look at how we are doing on global trade, specifically in advanced technology products. Right? Maybe it's fair to say, oh, the United States shouldn't make t-shirts anymore. But surely the premise of globalization, the premise of a well-functioning capitalist system, was that we would be a leader in advanced technology products, and certainly we were. When the Cold War ended, we had a quite large trade surplus in advanced technology products, and that has completely collapsed. In fact, I stopped right before COVID in this chart. If you extended that down to 2025, you'd be down below this banner, larger than a $300 billion deficit. So the US has simply ceased to be a leader in produced productive capacity, in innovation on technology in the real world. Certainly in software and AI and social media apps, lots of good stuff happening. But in the kind of economic activity that is actually going to spread prosperity broadly to large numbers of workers, to those communities all across the country, we have simply stopped doing it. And the consequence of that, I tried for a long time to figure out the best way to capture what has this actually meant for American society. And the best I came up with was this. At least in the US, our mental image of a decaying, failed society is post-Soviet Russia. The idea of rampant alcohol abuse, sort of just drinking yourselves to death with vodka in a failed society, produced death rates that looked like this. This is the death rate in Russia after the end of the Soviet Union from alcohol abuse. This is the death rate in the United States from opioid abuse. Okay, we are now losing, relative to our population, death rate from drug overdoses comparable to the very peak of the alcohol abuse in post-Soviet Russia. It equates to 100,000 deaths a year. For every death, you probably have, let's say, 10 addicts. For every addict, you have a whole bunch of other people who are affected, grandparents raising grandkids, employers who can't rely on workers, declining communities. Everybody in the United States, unless you are in the most bubbled, upper-class, wealthy community, knows somebody who has died of an opioid overdose. And so that is the situation we face. I think much more than GDP per capita, much more than any measure of productivity growth generally, that reflects why the United States has decided we have a much more serious problem than can be fixed with the kinds of small economic reforms you were seeing prior to Donald Trump. And so we needed an explanation for this. Why did this happen? And I think the core of the theory, what people are realizing is actually this was not surprising. This was actually the plan. Not the downstream terrible effects, but in fact the economists that promoted this kind of thinking thought that this was the outcome that we would get. This is Glenn Hubbard, who was chair of the Council of Economic Advisors for George W. Bush. He emphasizes that since the dawn of their discipline, economists have understood the goal of the economic system to be optimizing consumption, producing goods and services as cheaply as possible. We have done that in the United States. There is no question we have maximized consumption. There is no question our trade policies have led to accessing goods and services as cheaply as possible. The problem is that that and that alone is far from sufficient to support a healthy society or a healthy nation. This is Jason Furman, chair of the Council of Economic Advisors for Barack Obama. Economists understand imports are actually the good thing that is what we enjoy. It's the benefit we get from trade. Exports are the unfortunate thing we do just so we can get the desirable imports. Okay, there is actually a view that the larger the trade deficit, the better. That if we can get the rest of the world to send us stuff and we don't have to make anything in return, that is the ideal. And gosh darn it, we did that pretty well too. This is Stephen Moore, longtime editor of the Wall Street Journal editorial board, founder of the Club for Growth, which is one of the main free market activist groups in the United States. He and I were having a debate on immigration and wages. It was one of those very productive debates where we actually got to the crux of it. And the crux of it was this: he believed cheap labor leads to a booming stock market. That benefits everyone. Now I said, does it benefit the cheap labor? But if you believe these ideas, it doesn't matter. That's a ridiculous question. What matters is if you can consume more. And so we also pursued an immigration policy that said the more cheap labor we have, the better off we will all be. And then finally, I think it's important to put up a quote from someone like Paul Krugman, who really did acknowledge from the beginning, no, globalization, asking American workers to compete with the lowest wage labor around the world is really going to be a bad thing for less educated American workers, leading in turn to lower wages for these workers. Now, what was the theory of what was supposed to happen? One theory was just sort of the economists hand-waving, well, in the long run, this will work out fine because we'll be more efficient, the investment will come, and everybody will benefit. Another model was well, we'll just retrain everybody to go do something else. But what we found is actually that, yes, people do go take other jobs. And yes, there are a lot of excellent service jobs in the US economy. I am the beneficiary of an excellent service job in the US economy. But the kinds of jobs that a manufacturing worker moves to when you take away the manufacturing jobs are almost always worse. They're certainly worse in pay, but they're also worse in all sorts of other ways. They are less stable. They don't have regular hours. They tend not to support other jobs within a community. And so this basic idea that the United States had that you see reflected here, partly it was we care about consumption, not production. But it was also fundamentally that making things doesn't matter. And you will still find people who say today, the United States is not a manufacturing power, and it should not want to be. That manufacturing is the old economy. But the cost of that approach to the overall health of the economy has been enormous. And so what I think you see people doing, certainly what I have been doing, is going all the way back to Adam Smith, because there's an idea that if we go back, that this is what Adam Smith said. Don't you believe in Adam Smith? But that's not what Adam Smith said. Adam Smith only uses the term invisible hand once in 2 volumes of The Wealth of Nations. And he uses it in a paragraph that actually begins with the clause, by preferring the support of domestic to that of foreign industry. He intends only his own security. And by directing that industry in such a manner as its produce may be of the greatest value, he intends only his own gain. And then we get to, he is in this, as in many other cases, led by an invisible hand to promote an end which was no part of his intention. Fun fact, the editors of the leading economics textbook in the United States just edited that out. Economics, the main textbook from 1945 to the 90s, simply said that Adam Smith had said that this is how the invisible hand works without those prerequisites. But if you look at what Adam Smith is saying, he's actually saying something a lot less interesting, frankly. The invisible hand as a metaphor, it sounds like this magical thing. Everything will automatically work. even if we can't see it, even if we don't understand it. But what he's actually describing is more of a truism. He's telling you how the system can work. He's assuming that, in fact, people are going to invest domestically, not overseas. He's assuming that the most profitable thing to do, that the capitalist is going to want to allocate his capital toward, is produce of the greatest value. And he says, if that's true, if people trying to maximize their own profit invest domestically to produce as much stuff as possible, then that activity will advance the public interest as well. But when you delete the rest of that and just say this works by magic, you stop worrying about the constraints. You lose the alignment where actually the things that are most profitable are things that are good for society. And then when they're not good for society, you just sort of scratch your head and say, I don't know why. Or you construct an entire theory of actually why they're good anyway. And so what you've seen in the United States in recent decades is entrepreneurs and business leaders finding lots of ways to earn a lot of money that are not especially good for society. Offshoring. That is what our laws said you should do. Certainly was a good way to earn a lot of money. Was not good for the American economy. Financialization, which is the term we use for the rise of financial markets and the finance industry as a place that absorbs the top talent, that absorbs a lot of the capital itself. You can make a lot of money running a hedge fund in the United States. MIT engineers, they go run hedge funds and they make an awful lot more money than they could make engineering great products. If you only read the last piece of this, you'd say, well, by the invisible hand, that will advance the public interest. But if they're not trying to produce the thing of greatest value, it's not going to advance the public interest. And so what you're seeing is that actually the American people in a lot of ways just have different priorities than what the economists who ran our policy have. This is based on a bunch of survey research that we did in the United States. We basically gave people a bunch of different statements reflecting different values and asked them, which do you think is preeminent in the United States today? Which do you think is actually most important? And the three places we found the biggest gaps were these three. So Americans would say, United States today, consumption is absolutely the prioritized value. We would like to see actually production and productivity be a much greater emphasis. In the United States today, the priority is on mobility, the idea that if things aren't working out for you in one place, you should move to a new one. If your community is dying, move to the city. But that's not what people want. For them, rootedness, the idea that they can actually build a decent life in the place where they grew up, is much more important. And whereas opportunity and dynamism as ends unto themselves are aggressively celebrated, typical American places a much greater value on stability and security. There's an extraordinary survey done by Pew Research, one of the real gold standard research groups in the United States. They ask people, which would you prefer, upward mobility or financial stability? And by 9-1, Americans choose financial stability. But we built an economy for upward mobility. And so if you rethink these things, you suddenly realize that huge swaths of how American policy has been done were simply wrong. They were bad for the economy, they were bad for national security, they were simply not aligned with the actual political concerns of the American people and their priorities. And if you think about what Donald Trump represents in that respect, go all the way back to 2016. We had a field of 16 Republican candidates who by any other standard would have been an extraordinarily strong set. We had a bunch of Democratic candidates, maybe not as strong, but Hillary Clinton at the top. And they were all there talking as loudly and excitedly about consumption, mobility, and opportunity and dynamism as they could. And Donald Trump got up and he talked about production, rootedness, and stability and security, and he wiped the floor with all of them. And we are still in the moment now of trying to figure out what that actually means. How would you actually serve these interests if these are the ones that matter to people? So I have a whole bunch of policy issues here, mostly to emphasize the point that from this starting point, you can talk about virtually any area of public policy and land in a different answer than you would have a decade ago. Some of them are very obvious. Globalization, you are obviously going to take a very different view of free trade based on this. You are still going to want trade. You are going to want the United States and Korea to have a close and effective trading relationship, but you are going to be very focused on that question of balance. You are going to say the deal that we have had where the rest of the world sends stuff to the United States and the United States sends assets back is not a good deal. It's not the rest of the world investing in the US. It's not us getting stuff without having to make stuff. It is in fact a hollowing out of the United States. And it's a double-edged sword because it hollows out our capacity today and leaves us in debt for the future. You're seeing a much larger interest in industrial policy. Till 5 or 6 years ago, industrial policy in the United States, somebody would think of Joseph Stalin. We don't do industrial policy. One thing people have realized is that actually for a long time the United States did a lot of industrial policy. That the entire history of American development was based on industrial policy, a very strong state role in channeling investment to productive uses, and that it is really only in this period beginning in the 1980s when we said we don't need that, making things doesn't matter, wherever the market sends the capital is best, that we have had all of the bad effects. And so whether it's the CHIPS Act, rebuilding semiconductor capacity, the SHIPS Act, returning to shipbuilding, there is now an acknowledgement pretty much across the political spectrum that some kinds of investment, going all the way back to Adam Smith, are more useful than others, that markets are not going to take that into account of their own, and if you want investment to flow to the things that the nation needs, you are going to have public policy play a role. Immigration obviously looks completely different if you flip this around. We have so many different problems with immigration in the United States right now. We have the illegal immigration problem, we have the temporary worker problem, we have the permanent worker problem, we have what to do with high-skilled immigration. I realize there might be a Korea-related issue on people's minds at the moment. All of that is entangled in this question of what are we even trying to accomplish with economic policy in the first place. You're seeing, especially on the right of center, much deeper skepticism of financial markets. You're seeing Republican senators go out and join labor union leaders in rallies against private equity companies, because there's now a recognition that a private equity company buying something, buying up a firm, firing a bunch of the workers, cutting it up, selling it off, even if that generates a profit for the private equity company, that does not mean you have created actual value. And you're seeing a real interest in competition and antitrust. For a long time, there was an idea that all that mattered in antitrust is consumer welfare. In our legal doctrine, that's very formal. If you are evaluating anti-competitive behavior, the only thing that matters is if they are raising prices on consumers. As long as consumers are benefiting, do whatever you want. And now there's a view, wait a minute, we actually need more than just low prices, and there are an awful lot of things companies could be doing that are bad in other ways as well. On the micro side, you're seeing a very different focus on labor. You're seeing Republicans much more interested in organized labor. Not necessarily some of the big unions as they operate today, but the idea that worker power is a good thing. That if you want to channel the energies of entrepreneurs, of capital toward actual productive things, you'd better have a countervailing force. You'd better have workers able to assert their interests and say, here are the things we care about too. You're seeing a very different approach to education policy. We have had in the US what we call a college for all model. We got rid of our trade schools. We changed our high schools, secondary schools into college prep academies. We said everybody's going to go to college. And if everybody goes to college and becomes a knowledge worker, we won't have to worry about all of the stuff that we got rid of. That has failed. It has been a disaster. And we are both realizing how we've failed the vast majority of young people and how we have now created a situation where we don't have the workforce we need for the kinds of industries we should be building. And so how to rebalance that, how to move resources out of higher education and beautiful college campuses and toward other pathways is a major focus. You're seeing a much bigger focus on family policy. Going back to that chart about the unaffordability of raising a family on one income, based on the standard economic data, households have more income than ever, there is no problem. But people across the political spectrum, and where you wouldn't have had in the past conservatives on the right of center, are saying, no, there is a real problem here. And at least until we fix these other economic issues, there's going to have to be a role for government in helping families to make ends meet. You're seeing very different attitudes toward technology, tech regulation, and a real skepticism that just because people stare at their phones constantly, they are happy staring at their phones, and that's what they want to be doing. You're seeing a recognition that children probably need some protection, that instead of just doing whatever is the fastest way to innovate, you actually need to rein that in. There's the famous phrase, move fast and break things in Silicon Valley. Move fast and break things is very cute when you're a $3 million company in a garage. Move fast and break things is not cute when you're a $3 trillion company whose product is in literally every hand in the country. And one thing you're just starting to see, this is one of the next big projects that we're doing at American Compass, is a rethinking of healthcare. For a very long time in the United States, healthcare policy was just, how do we get everybody healthcare insurance so they can all afford to go to the doctor? A very consumer-oriented mindset. We just need to get people more resources so they can consume more healthcare. And you're seeing, if you've heard of the Make America Healthy Again movement, MAGA, you're seeing in Republican interest in, for instance, community health centers. Maybe in some places the government really should just operate a clinic where you can go if you need care. You're seeing a shift away from this idea that markets will solve this if we just let them, and a recognition that the kind of healthcare people actually need to live healthy lives is not something markets are always well suited to provide, and that in fact you are going to need a bigger role for government. So what comes next? What is so interesting about the Trump administration at this moment is that we are at this inflection point. The first, I guess we're on 7 or 8 months, have been overwhelmingly dedicated toward demolishing things. Frankly, a lot of things that needed demolishing, picking a lot of fights, exposing a lot of problems. And I think, love him or hate him, everyone would say he has been very effective in doing that. The question now is, will there be a pivot to building? Will there be a pivot to actually replacing that with some of these ideas? Because if all you do is demolish, people might be glad some stuff has been demolished, but you will not be well remembered when you are gone. I think longer term in the United States, if you look at what is coming beyond Trump, you will see, whether it's J.D. Vance and Marco Rubio, some of the younger Democrats, a much greater commitment to these ideas. We are certainly not going back to what it was like before Trump. But for the next 3 years, a lot will come down to the question of how much Trump and his administration are interested in moving those balls forward versus to what extent they see more things that they are still excited to demolish. And so that is what we are working at American Compass. Hopefully that gives a little bit of perspective of things that can otherwise look purely chaotic that are happening in our country. And I would be happy to answer any questions that you have. I'll put this one back up. Thank you again so much for having me.